Okay, so you've brought us a really interesting mix today. We've got MMA, VERO, SXTP, MKDW, and STSS.
That's the list. 5 companies, quite different profiles.
And our goal here, like always, is to really dig in, cut through the noise, and, pull out the most important insights.
Exactly. Based on the info shared as of April 12th, 2025.
Right. And we've got data pulled from places like Yahoo Finance, stockinvest.us.
Globe Newswire, TipRanks2, a good cross-section of financial intelligence sources.
Gives us a solid foundation. So the plan is company overview, recent performance, future hints.
And then a quick compare at the end. Sounds good.
Perfect. Let's kick off with MMA. That's Mixed Martial Arts Group Limited.
Right. And maybe not what everyone first thinks. It's less about the actual fights.
It's more about the training side.
Yeah, exactly. They have things like the Warrior Training Program, the UFC Fit Program. They operate internationally.
Okay, interesting. So what's the headline grabber for MMA right now?
Well, the recent news that really stands out is about their partnerships, specifically with the UFC Gym Group.
Ah, okay. Yeah. Leveraging that big name.
Definitely. They're aiming for about $7 million in annual revenue from this.
$7 million? That sounds like a pretty significant target for them.
It is. If they hit that, considering the size of the martial arts industry, like $18.6 billion, it could really accelerate their growth.
Tapping into the brand recognition makes sense.
It's a clear strategic move.
So let's look at the stock itself. Price-wise, where are we sitting around April 12th?
The estimate is about $1.30 per share.
Okay, $1.30. And performance looks like it's up 10% in the last month.
Yeah, a positive recent trend. But zoom out to the last year.
Down 20%. Okay.
And the 52-week range is something else. $62.60 on the low end, $5 on the high.
Wow, that's quite a swing. And decent trading volume, too.
Yes, significant volume. Indicates a lot of interest or maybe speculation driving those moves.
So future predictions. Any sense of where it might go short term?
Well, there's some chatter about a potential rise maybe to $1.50 in the next 30 days or so.
Based on what? Those partnerships?
Partly that, yes. And also some reports of 200% year-over-year growth in certain programs.
200%? That's huge, if accurate.
It's sustained, yeah.
Yeah.
But, there's always uncertainty. Market conditions play a big role, too.
Always the caveat. Okay, so MMA, one to watch with those partnerships. Let's shift gears to VERO, Venus Concept, Inc.
Right. Medical technology. They make devices for aesthetic treatments, medical ones too.
And this one's had some big changes recently, structural stuff.
Yes, VER did a reverse stock split not long ago.
Okay, consolidating shares, boosting the price per share, usually?
Exactly. And they also did a debt-to-equity exchange.
So paying off debt with stock instead of cash?
Essentially, yes.
Yeah.
It can ease the debt load, but also dilutes existing shareholders. Yeah. Often signals some financial pressure.
Right. So post-split, what's the estimated price now? Around April 12th?
Looking like around $4.50 after that adjustment.
$4.50. And performance, the yearly change is down about, 16%?
Yeah, around 15.97% down over the year. Monthly is harder to gauge right after the split.
And another wide 52-week range here, too. $2.16 up to $17.49.
Definitely shows continued volatility, even after trying to stabilize things with the split and debt exchange.
So what's the outlook? Analysts seem a bit cautious.
Yeah, the general rating seems to be a hold. It suggests they might still be facing financial challenges that could limit growth in the near term.
So they need to prove those restructuring moves are working.
Pretty much. Stabilization depends on addressing those underlying financial issues. A cautious outlook for now.
Okay, VERO, dealing with financial adjustments. Let's move to SXTP, 60 Degrees Pharmaceuticals.
Specialty pharma. Focused on infectious diseases.
Right, and they have Arakota, which is approved for malaria prevention.
Correct. That's already on the market.
What's new or interesting with them?
Well, some positive developments recently. They've enrolled patients in new studies for tefenequine.
Which could have uses beyond malaria.
Potentially, yes. And they've also secured some new patent license agreements.
Both are generally good signs in pharma, right? Clinical progress and protecting IP.
Absolutely. Major potential catalysts for investor confidence and growth.
And it looks like the market reacted. The current estimated price is around $3.
Yeah, but check the last month's performance.
Wow, up 50%. That's a significant jump.
Huge. Directly linked to that positive clinical news, most likely.
But context is key. Still down over 82% over the past year.
Exactly. Shows the classic biotech pharma volatility. Massive swings are possible.
And that 52-week range, again, $1.41 to $36. Incredible.
It really underscores the risk and reward.
So future potential, could it keep climbing?
There's potential for sure. Some analysts have price targets, maybe around $5.80.
But heavily dependent on those trials succeeding.
Completely. Success in the clinic and effective commercialization are everything. Plus, they're looking into tick-borne diseases, fungal infections.
More potential growth areas down the line.
If things go well, yes.
Okay, SXTP, driven by clinical news. Next up, MKDW, MKDW Tech Inc.
Automotive electronics. Some interesting stuff here, like intelligent RV control systems.
Smart RVs, okay.
Okay.
And LiDAR sensors, too.
Yeah, definitely playing in some forward-looking tech areas within automotive.
But have they also been making financial moves, like VERO?
Looks like it. Recent share issuance, some debt conversion to equity.
Again, potentially moves to shore up the balance sheet.
Often, yes.
Yeah.
Can't suggest they needed to strengthen their financial position, maybe facing some underlying pressures.
And the stock performance seems to reflect some challenges. Price around 0.80 cents currently.
Roughly, yes. And it's down 30% over the past year.
But the last month looks particularly rough, down over 60%.
Yeah, a substantial fall. Around 62.96% in the past month. That's steep.
Suggests significant headwinds in the auto market right now, or company-specific issues.
Could be both. The broader automotive electronics sector has faced challenges. And again, a wide 52-week range. See your dollars in $23 to $16.
So the outlook is neutral. Kind of wait and see.
That seems to be the consensus. Recovery likely depends on things improving in their sector. Not seeing many specific price targets out there.
Okay, MKDW, tied to the fortunes of the automotive tech market. Finally, let's look at STSS Sharps technology.
Medical devices, pharmaceutical packaging. Their focus is on innovative syringe technologies.
With safety features, right? That seems important.
Very much so. Safety syringes are a growing area.
And they've been trying to grow, raising capital.
Yep, a recent $20 million capital raise. And they've got agreements for selling their secure guard syringes.
So moves aimed at boosting revenue, expanding reach.
Definitely. Trying to fuel growth and get their product out there.
But the stock performance, this looks rough.
Yeah, dramatic might be putting it mildly.
Current estimated price is way down, around $0.03, 3 cents.
That's about right. And the recent performance?
Down 92.8% in the past month, and nearly 100% down over the year. 99.66%.
Astonishing drops. Extremely volatile.
And the 52-week range reflects that perfectly, from just $0.01 up to $18.15.
It's about as extreme as it gets.
This kind of chart might scare off a lot of people, right? A huge red flag for risk-averse investors.
Absolutely. It screams high risk.
So the future outlook must be pretty speculative then.
Highly speculative. There's potential if, a big if, they execute on their manufacturing expansion.
And if those new sales agreements actually bring in significant revenue.
Exactly. Success hinges entirely on execution now. Huge uncertainty given the volatility. High risk, maybe high reward, but definitely high risk.
Okay, STSS, a very speculative play. So let's just quickly recap and compare these 5.
It's a really interesting group when you put them side by side.
The recent performance is just all over the place, isn't it? SXTP soaring 50% in a month.
Driven by that clinical news.
While STSS just plummeted over 90% in the same period.
A stark contrast. Really shows how company-specific factors and industry news dominate.
And the future predictions are just as varied. Potential growth seen for MMA and SXTP.
Based on partnerships and trials, respectively.
A cautious hold on VERO as it sorts out its finances.
A neutral, sector-dependent view for MKDW.
And then STSS, which is basically a bet on a turnaround.
Absolutely.
Yeah.
Each one is really facing its own distinct challenges and opportunities.
You've got MMA leveraging partnerships, VERO restructuring,
SXTP riding on trial results, MKDW battling market forces.
and STSS in that high-stakes race to commercialize.
It really highlights how different they all are, despite all being, publicly traded stocks.
For anyone listening, it's such a clear illustration of why you need to look under the hood, right? Understand the business, the sector.
The specific catalysts, the risks.
Yeah.
It's not just about the ticker symbol.
And thinking bigger picture, it's a great reminder about diversification, isn't it? Across different types of companies and industries.
Couldn't agree more. Understanding what drives each specific stock partnerships, trial data, market trends is absolutely key.
So wrapping this up, this deep dive gives us a snapshot, a moment in time for MMA, VERO, SXTP, MKDW, and STSS.
Right. Based on that April 12th, 2025 data we had, the market moves fast, things change.
Absolutely. So this is based on estimates and available info at that point. Always, always verify current data.
Yes. Check platforms like Yahoo Finance, stockinvest.us. Do your own homework before making any decisions. Essential advice.
Definitely. And that brings us to our final thought for you, the listener. We've looked at companies in martial arts, med tech, pharma, auto electronics, all with very different stories right now.
A real mix.
So the question for you is, considering this diversity, what factors do you think will be the most critical for their future success? Is it the tech, the partnerships, market conditions, management execution?
And maybe just as important, how does what we discussed today fit with your own view of the market, your tolerance for risk, and ultimately your own investment strategy?
Yeah, definitely some food for thought there. We hope this dive gave you some valuable insights to chew on.
I am thrilled to offer you an opportunity to earn a significant return on your invested funds. If you loan me a $20,000 sum, I will personally ensure a 10% return every year, with the money automatically zelled back to you monthly for 2 years. This is a fantastic chance to grow your investment with minimal risk, as your funds will be returned every month without fail. When the Fear and Greed Index indicates extreme fear, it suggests that there's widespread pessimism and anxiety in the financial markets. This could be due to various factors like economic downturns, geopolitical tensions, or unexpected events that have caused investors to become increasingly cautious. During periods of extreme fear, market participants may withdraw their investments, leading to decreased market liquidity and potentially causing asset prices to fall significantly. Healthcare companies often move differently than the broader market. Shorting health companies specifically might not provide a sound hedge against overall market movements, since they tend to have their own dynamics and influences. So, using healthcare companies as a hedge might not yield as effective protection as expected. Shorting healthcare companies can be a risky endeavor. Here's why. 1. Regulatory environment. Healthcare companies often operate under stringent regulations with varying government policies. Regulatory changes can either boost or damage stock prices. If a new regulatory framework is favorable, it can significantly affect the share performance of these companies. 2. Market sentiment. Healthcare companies are often subject to unpredictable market sentiments and investor psychology. A rise in healthcare costs or a public health scare could lead to increased demand, which is favorable for these companies' stock prices. If you enjoyed this content, please like, subscribe, follow for more updates, and don't forget to sign up for the exclusive bonuses down below.
Listen up, traders, it's your lucky day. Quick gains insights is here to stay. Subscribe now, come join the fray. Financial wisdom will light your way. Join Quick Gains Insights today. Like this video, pave the way. Sign up in the description, without delay. 4,000 free insights today. Let this video pave the way. Sign up in the description without delay. 4,000 free, let's slay.